$500 per month. That's it. Not 5,000. Not 10,000. Just 500. If you can save $500 per month and invest it properly, you'll have over $2 million by retirement. And I'm going to show you the exact math, the exact investments, and the exact timeline. But here's what makes this different from every other investing video. We're not just going to talk about index funds and walk away. We're going to build a complete 30-year strategy. Year by year, dollar by dollar. What to invest in at year 1. What changes at year 5. What accelerates at year 10. The exact moment when your money starts working harder than you do. This is the $500 per month roadmap. From broke to 2 million. Let's go. Welcome to Faceless Millionaire. Quickly hit that subscribe button and don't forget to click that bell icon. Let's break it down. Here's the math that most people never actually calculate. $500 per month, invested at 8% annual returns for 30 years. That becomes $745,179. Not a million yet, but we're getting there. Now let's extend it to 40 years. Same $500 per month, same 8%. $1,745,503. You just crossed the millionaire mark with $500 per month. But here's where it gets interesting. Let's bump the return to 10%. That's the historical S&P 500 average. 40 years at 10%? $2,655,568. Over $2.5 million. From $500 a month. Now you might be thinking, wait, what's the difference between 8 and 10%? It's just 2%. That 2% difference is $910,000 over 40 years. Nearly $1 million. Just from that extra 2%. This is why we invest in stocks, not savings accounts. Let me show you why starting age matters more than the amount you invest. Person A starts at 25, invests $500 per month until 65. 40 years total, ends with $1.7 million. Person B waits until 35, also invests $500 per month until 65. 30 years total, ends with $745,000. Same monthly contribution. Person A has nearly $1 million more, just because they started 10 years earlier. Those first 10 years, Person A only contributed $60,000 total, but that $60,000 turned into nearly $1 million in extra wealth. Time is the most powerful variable in this equation. Now let's compare 500 versus 1,000 per month, because you might be thinking you need to double up. 500 per month for 40 years at 8%, $1.7 million. 1,000 per month for 40 years at 8%, $3.49 million. So yes, doubling your contribution doubles your result. But here's the thing most people miss. Consistency beats amount. $500 every single month for 40 years beats $1,000 per month for 20 years. Let me prove it. $1,000 per month for 20 years at 8%, $592,947. $500 per month for 40 years, $1.7 million. The person who consistently invested half as much for twice as long has nearly 3 times the money. This is the power of compound interest. It needs time. The longer you give it, the more it dominates. But that's just the boring math. Here's where it gets interesting. Most people hear these numbers and think, cool, I'll start when I'm 30 or 35. But they don't understand what's actually happening year by year. Let me show you the exact progression. Year by year, what your account looks like when the magic starts happening. Years 1 through 5, the foundation phase. This is where most people quit. Here's what to invest in. 100% S&P 500 index fund, Bati or VU. That's it. Why? Because you're young. You have decades. You can handle volatility. And the S&P 500 has returned 10% annually over the long term. No bonds, no gold. No complicated strategy. Just the S&P 500. Let me show you what happens month by month in year 1. Month 1, you invest $500. Market is flat. You have $504. Month 6, you've contributed $3,000 total. Market is up slightly. You have $3,120. Month 12, you've contributed $6,000. Market had some ups and downs. You end the year with $6,480. Your first year, you made $480. Less than 1 month's contribution. This is why people quit. They invest for a year and think, this isn't working. I'm only up $400. But here's what they're missing. That 480 is a 8% return. Most savings accounts give you 1%. You're already beating them by 7x. And it compounds. Year 2, you contribute another $6,000. Now you have $13,800. You made $800 more dollars. Year 3, $6,000 more. Balance is $22,000. You made $1,700 in gains. Year 4, $6,000 more. Balance is $30,900. You made $2,900 in gains. Year 5, $6,000 more. Balance is $40,300. You made $4,000 in gains. Notice what just happened. Your gains in year 5 are almost matching your annual contribution. After 5 years, you've contributed $30,000 total. You have $40,300. That extra $10,300 came from the market. But here's the psychology trap. $40,000 feels like nothing. You're trying to build wealth and you have $40K after 5 years of discipline. Your friends are buying new cars, taking expensive vacations, and you're sitting on $40,000 thinking, is this even worth it? Yes. Because you're building momentum. Your first 5 years are like pushing a boulder uphill. Slow, exhausting, feels pointless, but you're building momentum. Once that boulder reaches the top of the hill, gravity takes over. It rolls faster and faster without you pushing as hard. We're about to reach the top of the hill. Year 5 to 10 is where everything changes. Here's why. You start year 6 with $36,738. Here's what changes strategically. You can start adding some international exposure. Maybe 10 to 20% of new contributions go to VXs instead of just VTI. Why? Diversification across countries. When the U.S. market is down, sometimes international is up. It smooths the ride. But we're keeping it simple. 80% U.S., 20% international. Now let's talk about year 7, the magic year. Year 7, your portfolio balance is around $52,000. At 8% annual returns, that $52,000 generates $4,160 in gains. Your annual contributions? $6,000. Do you see what just happened? Your money is doing 70% of the work. You're only doing 30%. This is the crossover point. The moment when compound interest starts pulling its weight. From here, it accelerates. Year 8, your balance is $69,000. Gains are $5,500. You're contributing $6,000, almost equal. Year 9, balance is $88,000. Gains are $7,000. Contributions are $6,000. Your money is now working harder than you. Year 10 milestone, $91,473. You've contributed $60,000 total over 10 years. You have $91,000. That's $31,000 in gains. But here's the real scenario nobody talks about. What if the market crashes 30% in year 8? Let's say you hit year 8 with $69,000. Market crashes 30%. Now you have $48,000. You just lost $21,000. Most people panic, sell everything, move to cash. I'm protecting what's left. Wrong move. Here's what you should do. Keep buying. In year 8, after the crash, you're buying stocks at a 30% discount. Every $500 you invest is buying more shares than before. Year 9, market recovers halfway. You're back to $58,000. Year 10, market fully recovers. you're at 100,000. By buying during the crash, you actually end up with more money than if the crash never happened, because you bought shares on sale. This is why you don't stop during crashes. The crashes are buying opportunities. But most people can't stomach watching their account drop from 69,000 to 48,000. So they sell. And they miss the recovery. Don't be most people. Year 10 to 20 is where you start feeling rich, even if you're not yet. Let me show you why. Year 10, 981,473. Year 15, 174,173. Year 20, 297,185. From year 10 to year 20, you contributed another 60,000. But your balance went up 205,000. Your contributions were only 29% of the growth. Compound interest did the other 71%. This is where the magic happens. Your money is working harder than you are. Let's talk about the crossover point. Year 12 or 13 is when your annual gains permanently exceed your annual contributions. Year 12, your balance is around 120,000. Annual gains at 8%, 9,600. Your contributions, 6,000. From this point forward, you could stop contributing, and your account would still grow faster than you were adding to it. Obviously, don't stop. But this is when you psychologically shift from I'm building wealth to my wealth is building itself. Around year 15, you should shift your portfolio allocation slightly, from 100% stocks to 80-20 stocks bonds. Why? You're approaching the halfway point. You have significant wealth accumulated. A little bit of bonds reduces volatility without killing growth. This is also when tax optimization becomes important. If you're investing in a taxable brokerage account, you can start tax loss harvesting, selling losing positions to offset gains and reduce your tax bill. If you're in a Roth IRA, you don't worry about taxes. Everything grows tax-free. If you're in a traditional 401k, you're deferring taxes until retirement. Understanding the tax implications at this stage can save you tens of thousands over the next 20 years. Now let's talk about the $100,000 milestone. Why does crossing 100,000 change everything psychologically? Because your money starts generating serious income. At 8%, 100,000 generates 8,000 per year, automatically. That's real money. That's a used car. That's a vacation. That's rent for several months. You start seeing your portfolio as an income-generating asset, not just a number. And once you cross 100,000, the next 100,000 comes way faster. Then the next 100,000 even faster. This is exponential growth. It's slow at first. Then it's very fast. Here's a real scenario. Let's say at year 10, you get a raise. You're able to increase your contribution from $500 to $600 per month. Just $100 more. What happens? Instead of $297,000 at year 20, you now have $356,622, an extra $59,000, just from adding $100 per month for 10 years. This is why increasing contributions with raises is so important. Every extra dollar you invest now is worth $10 to $20 later. The last 10 years is where millionaires are made. Here's the exact path. Year 20, 297,185. Year 25, 486,542. Year 30, 745,179. You're 40% away from being a millionaire. If you started at 25, you're 55 now. 10 years from retirement, let's say you increase to $600 per month at year 10. Your year 30 balance is $920,000. You're basically a millionaire. Now let's look at the 40-year scenario. You started at 25. You're retiring at 65. $500 per month, entire 40 years, 8% returns, $1,745,503. But let's say you increase to $750 per month at year 15. Maybe you got promoted. paid off debt, had more cash flow. Your year 40 balance is over 2.1 million. What can you do with 1.7 million at retirement? The 4% rule says you can withdraw 4% per year safely. 4% of 1.7 million is 68,000 per year. Add Social Security on top. Let's say 1,500 per month. 18,000 per year. You have 86,000 annual income in retirement without working. Just from investing $500 per month for 40 years, you're financially free. At this stage, your portfolio allocation should shift to 60-40 or 50-50 stocks bonds. You're preserving capital. You want less volatility. You're not trying to maximize growth anymore. Some people ask about real estate at this point. Should I diversify into rental properties? You can. But real estate requires active management. Tenants, repairs, mortgages. It's not passive like index funds. If you want diversification, you can add a REIT ECF. That gives you real estate exposure without being a landlord. But honestly, if you have 1.7 million in index funds at retirement, you probably don't need real estate. You've won the game. But what if you can't do 500? Here's the adjusted plan. Not everyone can start at 500 per month. I get it. Life is expensive. Let's talk about adjusted plans. $250 per month. 30 years at 8%, $372,590. 40 years at 8%, $872,751. You still become a near millionaire with half the contribution. It just takes 40 years instead of 30. $750 per month. 30 years at 8%, $1,117,768. 40 years at 8%, $2,618,255. You're a millionaire in 30 years, multi-millionaire in 40. But here's my favorite strategy. The escalation plan. Start at $200 per month. Every 3 years, increase by $50. Year 1 to 3, $200 per month. Year 3 to 6, $250 per month. Year 6 to 9, $300 per month. And so on. By year 30, you're contributing $500 per month. But you started way lower. Final result at year 40 with this escalation, $980,000. You're almost a millionaire. And you started with just $200 per month. This removes the I can't afford 500 excuse. Start with whatever you can. 200, 100, even 50. Just start. Then increase as your income grows. The worst plan is the one you never start. But let me tell you about the mistakes that kill this plan. Because I see them all the time. Mistake number 1, stopping during crashes. 2008. Market crashed 57%. People panic sold. Moved to cash. The market recovered fully by 2012. 4 years later. If you kept buying during the crash, you actually made more money. People who sold in 2008 and stayed in cash, they missed one of the greatest bull runs in history. 2012 to 2020, the market tripled. Don't stop during crashes. That's when you buy more, not less. Mistake number 2, switching to stock picking at year 5. You've been investing in index funds for 5 years. You have 40,000. You see Tesla or Nvidia or whatever stock is hot. You think, I'll switch to individual stocks and grow faster. Bad idea. 90% of individual stock pickers underperform the index. You're not special. Neither am I. Stick with index funds. Boring wins. Mistake number 3, cashing out at 100,000 for a down payment. You hit 100K. You want to buy a house. You pull the money out. Now you're starting over at 0, and you lost all the compound interest that 100,000 would have generated for the next 20 years. At 8%, that 100,000 becomes 466,000 in 20 years. You just gave up 366,000 in gains to buy a house slightly sooner. Keep your investments invested. Save separately for a down payment. Mistake number 4, not increasing contributions with raises. You start at 500 per month. 5 years later, you're making 30% more income. But you're still contributing 500. Where's that extra income going? Lifestyle inflation, bigger apartment, nicer car, more eating out. Instead, increase your investment by half of every raise. Raise gives you 300 more per month. Invest 150 more. You still get to enjoy the raise, but you're also accelerating your wealth. Mistake number 5, checking your portfolio daily and panicking. The market is down today, down tomorrow, down next week. You check every day and you see red. Panic sets in. I'm losing money. I should sell. No, you're not losing money. The market is volatile. It goes up and down. Over decades, it goes up. Stop checking daily. Check once a quarter or once a year. The less you look, the less you panic. Set it and forget it. That's the winning strategy. 500 per month, 30 years, $745,000, 40 years, $1.7 million. That's the plan. It's not complicated. It's not sexy, but it works. Your first million takes 25 years. Your second million takes 5 years. That's compound interest. If you want to learn more about the psychology of reaching your first 100,000, check out my video on why the first 100K is the hardest. Link in the description. And if you're wondering whether to start in your 20s, 30s, or 40s, I broke down the exact differences in my investing by age video. Also linked below. Here's my question for you. Can you actually save $500 per month? If not, what's your realistic number? 200? 300? Drop it in the comments. Let's hold each other accountable. Thanks for watching. No face, no courses, no bees, just real math about building wealth. I'll see you in the next one.